Good evening and welcome everyone to tonight's webinar, Chat with the Banker about non-recourse loans. My name is Dmitriy Fomichenko and I'm the founder and president of Sense Financial Services. I will be your host tonight. Just a quick disclaimer that Sense Financial is not a fiduciary. We do not provide legal, tax, investment, or accounting advice. If you need such advice, talk to a qualified professional. Our expertise here at Sense Financial are self-directed retirement accounts with checkbook control. That is our specialty, and we're happy to answer all of your questions regarding that. And certainly our guest presenter, Ryan, will be happy to answer any questions related to non-recourse financing. But before we jump into guest presentation, I just wanted to take a few short minutes to give you a few slides overview about Sense Financial. I do see a number of new names here, those that are unfamiliar with us. So let me just take a quick moment and do that. We are a boutique financial services firm specializing in self-directed retirement accounts with checkbook control. We have been serving clients since 2010. One of our focus and one of our core values is to provide excellent service to our clients. We have hundreds of five-star reviews on Google, Better Business Bureau, LinkedIn, Yelp, and bigger pockets. We have assisted over 3,000 clients, established more than 4,000 self-directed retirement plans since then. And most of our business comes through referrals. We don't advertise, we don't do almost no marketing, and it's mainly by word of mouth from satisfied clients. Our goal and mission is to help our clients obtain control and protect their retirement accounts. Proverbs 21:5 says that good planning and hard work leads to prosperity. And we know that you work hard for your money, whatever it is that you do, whether you're running a business or employed, working at a job, or you're in real estate, perhaps, but you all working hard for your money. And we want to make sure that your money is working hard for you. And so we do that by coming along your side, and basically in the area of retirement funds, we want to make sure that your money is working hard for you. And one of the aspects, which is the topic of tonight's presentation, is non-recourse financing, because when you use leverage in investing, you're actually using somebody else's money. It's not just your money that's working hard for you. Now you're employing somebody else's money working for you. Well, for those of you that are not familiar with self-directed retirement accounts, just a quick comparison with the conventional retirement account, whether it's an IRA that you have, individual retirement account, or employer-sponsored plans such as 401k or 457 at your employer, your funds are controlled by the custodian, and they control the investment choices. And those investment choices are confined to the stock market. So you can only pick from the platform that is available or available to you by the custodian, just a handful of mutual funds. But with the self-directed retirement account, you have virtually unlimited investment options, including many of our clients invest in real estate, do private lending, invest in private businesses, and so much more. Just a quick example of the makeovers that we do for our clients. Jason is one of our older clients. He's been with us for a long time, over 10 years, in fact. But before coming to us, he had a couple different retirement accounts valued about $135,000. He was actually losing money in the stock market, and he's watching his retirement account statements, balances going down. So he reached out to us. We set up a self-directed plan with checkbook control for Jason, and he was able to make 3 investments, purchased a rental property, invested in his brother's business, and then lend the rest of the money as a real estate note. So he immediately started collecting about $1,000 a month in cash flow. And his portfolio continued to grow. But from the day one, he started receiving a cash flow and a protection from the market fluctuation, because no matter what his market is doing, his rental property is there. It's a solid piece of real estate. It's not a paper, and so is the real estate note protected by real property. So that's kind of example of what we can do for you. The benefits of a self-directed IRA and solo 401k is that, number one, it allows you to invest in alternative assets, which means you receive true diversification. Your investment returns are tax deferred if you invest using a traditional IRA or 401k, or in case of a right, it's tax free, which can be mind boggling. If you think about this, if you grow your wealth tax deferred and then your distributions are tax free, the power of compounding can work in your favor. You can also leverage your funds using non-recourse loan, and Ryan is going to talk about that in just a minute. You also or we give you the ability to control your funds with the checkbook control. So we allow you to either bypass the custodian and middleman or completely eliminate that in the case of a solo 401k. Solo 401k specifically, those who are eligible, meaning if you are self-employed or own a business, is also a great tax shelter. It enables you to shelter nearly $70,000 of your income from taxes each year for each participant. If you and your spouse are in the business together, you can double that money. So the savings can be $20,000, $30,000, $40,000 a year. Again, pretty significant. But with so many options that are available for you, virtually unlimited investment options, you need to understand the restrictions. And again, I'm just giving you a quick overview. Remember that you're not allowed to invest in collectibles with your IRA and into life insurance. And in addition to that, your retirement plan, an IRA or 401k, is prohibited from engaging in any transaction with disqualified person, which is yourself and your immediate family member. Unlimited investment options, as I said, and true diversification. Essentially, if you're just investing all of your eggs in one basket, so to speak, you certainly can lose them all. The Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. There's a lot of wisdom there, and certainly with the self-directed IRA, you can accomplish that. Well, with that, I'm going to pass the mic over to Ryan with Titan Bank. And Ryan is going to be our tonight's presenter. He's a visionary bank's executive vice president. He's a coach and strategic solution provider who excels in multiple industries. He's a seasoned leader with over 20 years of experience in lending and banking, and he possesses unmatched experience in fostering growth and cultivating relationships across diverse geographies. He has impressive track record, which includes national director for residential wholesale lenders, executive director positions within FDIC banks, and also accomplished in commercial real estate and SBA financing, corporate finance, real estate tax strategies, and equity capital specialization. So he has plenty of experience, and please get your notepads and pens. If you guys have any questions for Ryan about non-recourse financing, there is a Q&A section there at the top, so be sure to do that. Just type your questions there, and we will have a Q&A at the end, and we'll address those questions. Ryan, welcome again, and go ahead and take it away.
All right. Dmitry, thank you so much for the introduction, and that was very generous of you. Everyone, thanks for attending tonight. And as Dmitry mentioned, I'm a EVP over at Titan Bank. We are a little bit about the bank. We are a federal bank, and we've been around since 1907. And I'll get a little more into that. But so we specialize in the self-directed space, solo 401ks, and anything really with self-directing is what we how we got into this business. And then we ventured into, of course, doing the non-recourse loans, which I'll discuss more of a high level of what they are and some of our guidelines of how we look at it. There are some other lenders out there, so we may vary a little bit, but overall, I would say we're pretty we're probably in the middle of most of the traditional guidelines for the non-recourse loans. And this is more of just an educational of what they are and what to look for. And thank you so much for being here. Like I mentioned about Titan Bank, we are federal, 1907, and we have about we've done about $2 billion in loans with our affiliate, a little over $2 billion in terms of small balance commercial, residential. Everything we do is pretty much is around small business or investment type transactions. We don't do any owner occupied properties. So everything we do is related around a commercial asset, whether it's a multifamily, self-storage, it's a mixed use. So everything we do as a bank is around the commercial, including the self-directed retirement accounts for the non-recourse. So what is a non-recourse? I'm going to get they're really tailored for. I mean, there's other non-recourse loans. You can do a non-recourse, in commercial. You can do it with a business. Typically, most of the time when you do a loan, it is recourse, and I'll get into exactly the difference between the two of them. But mostly, non-recourse means there's no personal liability. So that's the biggest part of it. When you do, anytime you buy a primary residence or an investment property, there is personal liability, which means the bank or the lender can go after you personally after they go after the collateral. So if there's a deficit, you have a property and you default on that particular property, and there's a deficit, say, of $30,000-$40,000 after legal fees and taking the property back and fixing it up and selling it. Then for a recourse loan, typical Fannie Mae, Freddie, any loan you might do for a primary residence, the lender can go after you personally and go after your assets, put a lien on your house, put a lien, try and put collections on you. Where with a non-recourse, you're not able the lender is not able to go after you personally. So there's no personal liability. It doesn't go on your credit. There's no judgments or liens, anything outside of that. It's strictly a collateral based loan. And that's the biggest difference from, besides just from a high level, that's the main difference from a non-recourse to recourse. Now, of course, when you do the recourse loans, just your standard investment loan through one of the federal agencies or through a lender, you probably get a little bit lower rate, longer term. Again, they can seize a property, plus they can go if your personal assets are liable. They potentially could garnish wages depending on what state you're in and the lending laws in those particular states of where you're domiciled at. It's definitely a lower risk loan to the lender. With the non-recourse, again, it's just opposite. It's a little bit higher rate, probably a shorter term. We only can go after the property itself, and it's definitely more of a risk because there's less ability for us to get our money back if there was a default on that particular loan. So that's really some of the differences between recourse and non-recourse. The terms, typically on a traditional loan, you do a 30-year, you might have a 40-year. There's interest-only options. You have balloon payments available on on traditional lending. There's you have with the non-recourse, you're pretty limited on what's available out there. It's there are some ARM products which are 5-year, 10-year. There's some 7-year ARMs, and those products, you're fixed for 5 years, 7 years, 10 years, and then you may have some fixed rate options. Right now, there's not a lot of fixed rate options. I want to go over that just with the current lending environment. This is pretty broad in terms of what's typically available, but in the current rate environment and the market, in the current credit environment we're in, there's really very few fixed rate options available out there. Between based on what I'm seeing in the market, and you may still be able to find it, but for the most part, majority of the banks and lenders want to offer a 5-year fixed rate option on a 20-year amortization, so the payments over a 20-year period. 25 years is rare. It has to be a very good property and in a really sought after area to go to the 25 years. But I will tell you, majority of the loans we're doing are going to be around that, probably a 10-year ARM on the 20-year amortization is majority of what we're currently offering for particular projects. And so I'll get into kind of the nuts and bolts of the non-recourse. When you typically go and buy a primary residence, or there's or even an investment property, you usually can get in for 5%, 3% on, if you're doing a 3.5% on FHA, or 5% on conventional. Even on investment properties, normally 20% down payment. And with the non-recourse, as you can see, it's you're really need to put down 35 to 50% down payment. That's I would say worst case 50%, but anywhere from that 35 to 50% down payment. Again, because it's more of a riskier loan than there's no government backing it, or mortgage insurance, or so you don't have the other avenues for the lender to get their money back. And the loan amounts, they are a little higher. 200,000 is kind of our threshold. There are some lenders doing $100,000 loans, but typically on the non-recourse loans, you want to be from that 200,000 range loan amount, which would put you around a $315,000 property to get to that 200,000 after you put down the down payment. So that, just to give you an idea, you really want to consider having around 120 to 130,000 in your retirement account to go and get to that 200,000 loan amount. We typically don't want to go over $1 million on the non-recourse. There's some situations where we will, but anytime you go over $1 million, that really goes into more of a really structured commercial loan. And we just need to get a little more information from the sponsor, from you, that where you're actually have some history, because when you get into larger loan amounts, you can really do a loan under the retirement, and you can buy any type of property. Majority of the lenders want to stick to 1 to 4 units. We will consider doing 5 to 10. Commercial property, like I said, mentioned self-storage. We'll really consider doing any type of property, but majority of the lenders out there, just as more of a knowledge, want to stick with the 1 to 4 unit. So single family and 1 to 4 units is really where you want to be when you're looking. Just when you get to the 5, 10 units, usually we want to see a lot more experience. Not your first rental. We want to, so you have actual experience having these type of properties, so you know how to manage them, even though you're not directly managing them, which Dmitriy can get more of that, because you're not, there's certain rules around self-directing, and typically you have a management company that you hire, and there's some other caveats which we don't necessarily get into as from the bank perspective, but you definitely would want to talk to Sense and just make sure you're not doing anything that's going to disqualify you as an individual. So that's some of the stuff you'd want to talk to your tax advisor, Sense, just to get a little more guidance on when you're investing in these properties, you're not going to jeopardize your retirement. So So there are certain restrictions from a lender. Again, these are really tailored to what we do at Titan. It doesn't mean it's across the board. There's other lenders that may do raw land. They might do construction, the land development, farming. We tend to stay away from, this is what we have restrictions. I have mini storage in there. We do make some exceptions to mini storage. We actually I've done some residential condos, but in generality, we want to tend to stay away from the condo and the condo hotels, any hospitality, particular properties. Like I mentioned earlier, the multifamily. You really want to be more experienced. Not your first project. We look for that in the sponsor, that you actually know kind of what you're doing. We will do townhomes. We'll look at some mobile home stuff. So I mean, there's certain things, like these are our kind of our general guidelines, but depending on who's the actual sponsor of the project and the experience level, just like any lender, they may or may not deviate from the standard guidelines that we have. So this is definitely a high level, but we don't do like fix and flips. There are other lenders that will do fix and flips for the non-recourse. So I don't want to think that when you look at this that, oh, that's across every lender, because the other lenders will allow those type, some of these other loan products in the market. So there's some other requirements to consider. The DSCR, which is debt service coverage ratio. So when you're doing a non-recourse loan, you don't qualify personally. You qualify off the actual actual property, the rent, the lease that's in place on the property. So so your payment, your ability to repay that loan is off the actual collateral. So that's the most important part. You're not pre-qualifying on like a traditional loan. You qualify off credit. How's your credit score? Have you paid your other debts? We do look at that, but that really has nothing to do with the loan itself. We just want to make sure there's no major credit, any type of major credit issues, in the past. So credit worthiness is important from the beginning, but ultimately we base it on the property. So I have a lot of clients call me and say, well, I want to get pre-qualified for a non-recourse loan. We can't pre-qualify anyone without an actual property. So that's important, not just us, but other lenders. We want to know about your credit worthiness, but ultimately, in order to qualify you, it's all really based on the property itself. So the debt service coverage ratio, we have a 125 requirement. Some lenders might have 115, some have 110. I've even heard some people doing a 100%. What that means is your net income on that property is so after you take your net income, after expenses, your insurance, your taxes, your HOA, your net income, say it's $1,000 net income a month, or say $1,250. If your principal and interest payment on that mortgage is $1,000, we want your net income to be $1,250. So we want your net income after your taxes, insurance, and HOA to be 125% of your principal and interest payment, whatever that is. So I just use 1,000 as an example. We want to see $1,250 for your net income. Normally, most lenders want to see a current lease in place. We do loans without them. We just go off the market rents. So we'll do an appraisal and get comparable rents in that market, and that's what we base your rental coverage on, or the debt coverage. If you have a current lease in place, we will use that as the income. Majority of the lenders want to have a long-term lease, like a 12-month lease, comparable versus, some people, I get calls from clients and they want to do Airbnb or VRBO and, the short-term rentals. We typically base our decision on the actual long-term 12-month lease, just because if we were to take the property back, that's what we're going to look at. If we had to, sell the property and market it, we're going to market it on the most conservative approach versus the short-term rentals. So just think about that when you're looking at properties in vacation areas. You might want to look at what's the short-term and long-term rental rates. We do want escrow required. So insurance or taxes, we want to have that in the actual payment itself. So the reserves, the reserve requirements for us is we want to see 15% reserves on the actual loan amount itself. So if you're a $200,000 loan amount, we want to see a 30,000 in reserves in your retirement account, and that's really to protect you. And also, if there's any unforeseen expenses, or maybe the property is not leased out, or the tenant moves out, anything unforeseen, because you can't use your personal funds when you're buying a property inside your retirement plan. So that's why you want to make sure you have that reserve buffer, just in case there's a rainy day and you need to use it. You have it available. So we do want to see a 15% reserve requirement. So I've seen anywhere from 10 to 20%, typical lenders out there, but ours is 15%. We have a management company. We would prefer you to have a management company. We do make some exceptions outside of that, but I know it's typically recommended to have that, especially when you're inside your 401k plan. It's better to kind of be hands off, but that's we don't necessarily police that part. That's not really our job as a bank. We do the loan based on the our parameters, but it is recommended typically to have a management company, or we definitely want you having a management company if you're in California and you're buying you have a property in Florida. We want to know how you're going to manage that. So we pretty much, unless you're it's in the same city of where you live, we normally want to see a management company, and that's pretty typical with most lenders. The detailed financial statement. So we want to see a personal financial statement. So that's the one thing we look at, is just your overall your worth, and so just really for us to analyze, we want to make sure we know who you are as a client, in person. So we want to know that, just from to make sure we know who we're lending to, we ask for that personal financial statement. Even though we're not basing our decision on that, we still want to know our customer, know who we're doing the loan for, ultimately, who's going to be, paying the mortgage and managing the property. So that's just, we want to see that, and which is a little different from a traditional loan where you do your tax returns, your bank statements. We want to see your bank statements from your retirement account. We want to see a personal financial statement, just so we know who we're actually lending to from a lending perspective, not necessarily how to qualify you for the mortgage itself. So it's not really for the ability to repay. It's more of knowing who we're lending to as a client. And then the other thing that we look at is the 10% management fee. So we do look at anywhere from a management and vacancy factor. So we take that into consideration when you're doing the property. When we're running the numbers, we look at a 10%. I will go down to 7.5% for that's just on your actual, the actual payment itself, the actual lease. Most management companies charge anywhere from 5 to 10%, depending on the market and the time. So we figure 10% worst case, but we'll go down to 7.5%. So just when you're calculating your income on the property, you want to always calculate anywhere from 7.5 to 10%. Because some lenders will do lower than that, maybe 5%, but just when you're figuring out your actual net income, you want to put that in there as a 10% vacancy and management cost, when you're calculating your cash flow on the property. And then there's some other parameters we look at. We do look at the areas in terms of if it's in a major metro versus rural. So just when you're out there looking at properties, we typically, again, other lenders might look at it differently, but we want to see a property that's in a more of a major metro area. So we have marketability on that property. If it's in the middle of, Montana or Wyoming, and there's just not a lot of properties to market, and it's probably something we may not lend on. But again, it's so just when you're looking at property, or if they're in a mainly a vacation rental area, and all based on short-term rentals, we'll look at those, but we'll take the more conservative. So the cash flow, it might be there from a short-term rental perspective, but when you go for long-term, the cash flow is significantly lower. But we can look at those. It's a case by case. I don't want to say that we're going to say we can't do certain things. It's more of the best way to do it is identify the property and then let us know of that particular property, so we can analyze the area and see if we're willing to be able to do that particular loan, because every property and every sponsor is a little different, on commercial. And so I never want to say we can't do something based on guidelines. It's kind of like, let me know the property address. Let's look at it. Let me know your history, your experience, and then we can take it from there and see if we're able to do the loan for you. So that's some of the stuff you just. But this is very general of the guidelines I went over and what to look for in the non-recourse. It's a great way to leverage. One thing, I don't have in the slides here is, I have a lot of clients that, I don't have 115,000 or 130,000 to, put down on the property. Well, we're able to do multiple investors. So you could potentially have you and partner with someone else on the property. We allow that. We allow we even do retirement clients that will partner with a private someone like a private lender, and now that private lender has recourse on their 50% or 40% of whatever they're doing on the property. But that's one thing to consider, when you're getting into this space, and maybe you don't have enough in your retirement, but you want to do it. It's great to partner with someone, whether it's another person that's involved with Sense, or maybe a private investor that you're able to put in money on that. Those are some things to consider when you're looking at properties. And it never hurts to go to these private investors, because they have a pretty good experience, and they typically, you obviously want to vet them out, but they know the market maybe a little more than if you're getting into it for your first time. So just something to consider, that we will allow that type of structure on these loans. And then, but that's Dmitriy, that's really, I could go into more detail, but that's majority of my what I had to discuss. And I don't know if you want to add anything to that, or.
No, we'll jump into questions here in just a moment. But yeah, thanks for the presentation. That was very informative, and we do have a number of questions here. If you can, let me just pull them out here in just a moment.
Oh,
slide. Go ahead. Right.
I apologize. One thing we do lend nation. I just said we lend nationwide. It is domestic. We don't do any. I get clients that call. They're looking to purchase in overseas, and right now we only lend on U.S. based properties, and it's, again, that's just us. I mean, there may be some other opportunities out there. It's not restricted. Just we only lend in the 50 U.S. So it's I wanted to mention that as well.
Yeah, thanks. I'm actually not aware of any lenders who will lend outside of the U.S. Are you, Ryan?
I'm not aware that
non-recourse. Yeah, non-recourse. That's probably going to be challenging to find. So if you're looking to purchase a property that is outside of the U.S., and we have clients who've done it. We have clients who purchased in Canada, in Japan, in South America, a few countries there, in Europe, in India as well. Several actually have done it in India. So, but it's most likely has to be a cash deal, because you're probably not going to be able to get a financing. But let's jump to questions. Mohan is asking, you don't offer loans for single family homes?
So sorry, good question. So we do 1 to 4 units I put in there, and we absolutely do single family homes. Just not, of course, just not owner occupied. So just for the non-recourse, of course, you're doing it as an investment property. But no, one unit, 2 unit, 4 unit. We pretty much do anything residential, up to, I've done 20 unit properties. We've done some small apartment complexes. So we're pretty unique. Majority of the lenders out there will want to stick between single family or like a duplex or a fourplex. Most of the lenders that I've seen really don't want to go over a fourplex.
Sure. And what is the minimum loan amount?
So with us, we're 200,000 now. I do want to. There are some. I know some lenders out there will do 100,000 that I've seen, or 250. We're 200. The one thing that is a little different. I do some loans with, there's some clients that maybe they have 5 or 6 properties or 10 properties, and they're looking to maybe pull some which I didn't mention in the slides. They're looking to pull cash out, or they're looking to, they want to, free up some more liquidity to go buy more homes, and maybe the combined 5-6 homes, equal to 200 or 500. So I can look at doing a portfolio type loan where I'm refinancing multiple properties and able to get above that 200,000 threshold.
Sure. Joy is asking, are terms and amortization not the same? Can you explain the difference?
So the terms, so we offer so we do a 5 and 10 year. Right now, we used to do a 7 year, 10 year, 15 year. So the amortization is what your monthly payments based on. The term is actual, like if you're doing a 5/1 ARM, but it's a 25-year amortization, the rate's fixed for 5 years. So we lock it in at a certain rate of whatever that rate is. And right now we go off of the treasury. We use the treasury index as what we base our rates on, and then we have a 4% margin. So today the 10-year, I say the 10-year treasury because it's actually better than the 5-year. It's been inverted for whatever reason. It's sitting around 4.08 the last when I looked at it recently today. So your rate would be 8%, or a rate around 8%. And that's fixed for 10 years, but the principal and interest payment is based on a 20 or 25-year amortization. So your payment's based on the amortization, but your rate is based on the 10-year. It's a 10-year ARM, and then it readjusts after that.
Another question from Mohan, who's asking, is 10%, you were talking about 10%, does it include management fee and vacancy factor together, or 10% each separately?
It is a good question. It is separate. So we did lower that. I mean, we will go down to 7.5 each, so 15 total. So right now we know it's a little higher. Again, we'll look at it. We will look at situations, but it is 10% equal. So 20% total, or 15% if I can get it lower to 7.5 each.
Gotcha. Glenn is asking, will utilizing these loans to finance properties in my solo 401k generate UBIT, or unrelated business income tax?
So, we're not tax advisors, so we're the bank, but that's one of those things that you do need to look out for that. The UBIT, UBIT. So because you are leveraging and you are using a loan. But I would check with depending on what type of retirement account you have, whether it's an IRA or a solo 401k, I would check with your tax advisor on that. But I know that in essence, it could trigger UBIT.
Yeah, and the question was specifically about solo 401k. Maybe I can jump in and just comment on that. So the solo 401k will be exempt from the taxes on leveraged real estate. So if you were to finance rental inside of an IRA, definitely the portion of the income will be subject to UBIT tax. But if you're doing this inside of a solo 401k, then there will be no UBIT as a result of that. But
I stay very, because we do some IRA loans, so I don't want to. Yes,
sure,
but
sure. Yeah, but Ryan is correct. You got to talk to your tax professional just to confirm, because I'm not a tax professional either. I deal with solo 401ks every day, and I understand this, but ultimately I am not a CPA. So another question, Ryan. So can can I partner with just unrelated individual using my IRA funds to buy rental and get a loan?
yes, with us, we allow that. So we allow you to partner. I've done multiple loans where I had a retirement, a 401k or a client that is partnering with now from a tax perspective or from any of the legality in terms of what's allowed and not, but as long as it's unrelated, I mean, we don't get into that. We allow you to partner with really anyone, whether it's another retirement client or private equity, private investor. We allow that. There are some additional costs. I do want to say in terms of the documents. So we have to hire outside attorney for those, and there are some additional costs typically when we structure those.
Right, Ryan, just to confirm I heard you correctly. So if an individual has funds in a self-directed IRA or 401k, and they want to buy a property and they want to partner up, you can do the non-recourse loan because they essentially will be buying, I guess, a stick, right? Tenants in common, or do you require entity that they form some kind of an LLC where each party will be a member, or it's irrelevant? You can do it either way.
No, good question. No, good. Thanks for clarifying. So we prefer where they form it, like they have an LLC, and then the 401k will buy in at a certain percentage to that to that LLC, and then the private whoever the private investor buys in as well. So that's defined within that LLC that they formed, and then we divvy up. Now that private investor would be recourse. So if it's 60-40 or 70-30, we would have recourse. Potential recourse on that private investor, but not on the 401k.
Okay, so it will be non-recourse to the 401k, but it will be recourse to the other individual.
Correct. If they're exactly. So we do have the ability to, and that's what some of the paperwork's drawn up. So we have the ability, if we want to, we could go after that private investor for whatever their percentage was.
Gotcha. Okay, that's good to know. Scrolling down, do you need pay stubs when applying for a non-recourse loans?
We don't want pay stubs. We do want to see last year's W-2 or last year's tax returns, 2022, if you have them, or 23. I'm sorry, 2022, or assuming you have 2022 without an extension, or 2021. We only gather that information. We only gather that information just so we know our customer, and that's really more for our regulators when they want us to know that we know who we're lending to. So that's why we collect that information up front, but it has no basis on the actual loan itself.
Thanks for clarifying. Carmi is asking, hi Ryan, does Titan Bank provide loan products to foreign nationals, such as fix and flip loans and so on?
Currently, we only lend for we won't do any foreign national lending currently. It has to be a permanent resident, and we don't.
I think he's asking if he's a foreign national, but he's buying a property here in the U.S., and I'm assuming Carmi is asking about non-recourse loan. So if somebody who's a foreign national, but they have an IRA or a 401k, and they want to buy, I'm assuming they're not a U.S. citizen. So can you do a loan like that?
We probably wouldn't, and I just because I don't know how they would have their.
Actually, I've seen Ryan. I've seen, and I think we have a few clients like that who are not U.S. citizens, but they reside here. They do own a business here in the U.S. They don't have a citizenship, so they do have a retirement account, and they they pay taxes. They file tax returns, and so I think that's the nature of the question.
Okay. We probably would consider that. I probably want to drill down a little more. We and that we probably would consider that. I would it just probably take that offline a little bit more. I mean, I think we could consider. I mean, we onboard some we probably would consider that. So I would say definitely send that over to me. Not the fix and flip. We don't do any fix and flip, but the other scenario, send that over to me so I can look at it.
Okay, so Carmi, this is not a common scenario. This is something unique, and it's possible, but you got to talk to Ryan directly about this and about the specifics of your situation. All right, next, Nancy is asking, what is the average rate today?
I mentioned, so we go off Treasury. Typically I see anywhere from, so what's the 10-year Treasury is right around 4%, and we add a 4% to it, so it's around 8%. That's just us. I see anywhere from the high 7s to the low 9s is what I'm typically seeing in the market right now.
Gotcha. Sophie is asking, if partner with recorded loan is the portion of the recorded and recorded fixed for the future investment. I'm not sure if it makes sense.
With the partner with the recorded loan. Well, the rate.
Oh, I think maybe Sophie meant to say if partner is with the recourse loan and the portion is non-recourse. I think that's what she meant to say. And the recourse fixed for the future investment. Yeah, I'm not sure if I understand the question.
I mean, well, I'll try to. So I mean, the recourse and non-recourse, if there's a partner, they're going to carry forward forever. So I mean, they would carry forward. So the partner would have the private partner would have the recourse going forward, and then also the rate itself. I don't know if that maybe that's what the question. It adjusts after 10 years. So once your 10 years is up, it goes to whatever the Treasury is at that point plus 4%. So I don't know if that answers the question or not.
Yeah, I think that's what she was trying to ask. So if you have a partner who's an individual and you're using your self-directed IRA and you get a loan jointly together, then that loan is going to be fixed. It is one loan, so the term not the same for both partners because it is one loan. So if it's a 10-year fixed, it's going to be fixed for 10 years for the entire loan for both partners. Am I correct? Ryan?
Yes. Yeah. Yes. Correct. The term itself and it's all that would be the same. Just one would be recourse and one would be non-recourse.
So, Sophia, I hope we understood your question, but if not, reach out to Ryan directly. Next, Caleb is asking, can the properties be deeded into an LLC, trust, or a similar entity?
There should be no problem with that. We do. I've done solo, the solo K where they're in a trust or they're in an LLC, single entity. So that shouldn't be an issue at all.
Yeah, so they'll finance with any entity. Nancy is asking another question. Can you buy a property under an IRA and also have an investor? So I guess that's like a partner. So I think we addressed that question.
Yes, I think they would just have that investor. We wouldn't care, but if that investor's on the loan, then than they would be if they're just investing. Yes, that shouldn't be an issue.
Okay. If I have to move fast, next question from Anthony. If I have to move fast and purchase quickly all cash, can you refinance that? If so, is there a seasoning period? What will the LTV be?
No seasoning. Yes, we can do it. So yes, we can do it. There's no seasoning. It's just we're going to base it off the purchase price. So we wouldn't give any rapid appreciation. So whatever your purchase price is, and any type of hard rehab costs, if there were any, then we would just base it on those two for the value of the property, and then go ahead and do. Typically, we on a cash out, we want to be around 50, maybe 55% on the cash outs. But yes, we can do it.
And Ryan, if somebody was to refinance property that they already they already own, so what will the seasoning be for for them to use the appraised value and as the value of the property?
Usually we want to see at least 2 years on those, sometimes 3, but between 2 and 3 years. I mean, that is a baseline, but we could potentially go less than that. But that's we like to see 2 years at bare minimum.
Okay, and scrolling down here, Marish, I believe, asking, how about more than 5-unit apartment built before 1940?
We'll look at it, but I mean, we need to make sure it's been renovated and it's up to code. And there's additional parameters around those type projects. So it's a little more work, and that's why we tend to stay away from them. But we have done some.
All right. Ashot is asking a question, and so it's not really addressed to you, Ryan, but let me just read that and answer it. What is recurring return on investment for such property investment once the property is paid? You probably mean the loan is paid. So it all depends on that particular property. So there is no way to answer that question. Short. It depends on the property. You might be buying a rental for $300,000 and financing that's one option, or you might be buying a fourplex for $2 million. That's the numbers are going to be totally different for that one. So it depends on that particular investment. And then finally, we have a question from about private investor can be the same person as non-recourse person. I'm not sure I'm getting this question.
Like I think they're commingling, Dmitry. I think they're saying, can they do it together, like a private investor with a not like a retired, like the same person?
Oh,
I think.
okay. So if a client has an IRA and they using an IRA to buy a property, but they personally want to partner with an IRA to buy jointly, can you finance such?
Yeah, we can, but I mean, we don't really care. I just think that's more of a I don't know that's something you just want to verify with your tax professional, CPA. Just we don't have an issue doing that.
So it can be financed, but the challenge is, Mahan, is, and I get this question actually quite often, just regardless of the financing part, just can I partner with my self-directed IRA or 401k? And remember that you are a disqualified person. So when your retirement plan partners with a disqualified person, technically it can be done. It could be done, but you must follow very strict rules. And even if the transaction like this appears to be okay in the beginning, it's possible that it can lead to a prohibited transaction because of the involvement of a disqualified person. So I normally, again, generally speaking, I will not recommend such transaction, but we have to look at the individual situation there to see. But you definitely got to be careful by partnering with a disqualified person.
Yes.
All right. Well, we are up against the hour, and we just covered the last question, so the timing was perfect. Thank you, everyone, for joining us. Ryan, thank you for bringing your knowledge and experience to all of us. You guys have a good night, and we'll see you at the next webinar. I don't recall now when we have scheduled one, but I think we'll include that in so the recording is going to go to everyone who registered. You will receive the email. We'll also include the recording in our next newsletter. So again, thank you for joining, and you guys have a good night.